In this video, I'm going to show you 16 different ways of anticipating a trend reversal. A whole course can be made for each one of these methods, so keep in mind that I'm only going to give you the highlights of each method or technique. Without further ado, let's begin. The first way of anticipating a trend reversal is by looking at psychoanalysis. Psychoanalysis is not a very widely known method, but it can be very powerful when applied correctly and when combined with other tools. Before we understand how cycles are used to anticipate a trend reversal, we need a few basic ideas. Think of a cycle as a wave that oscillates up and down like you can see in this image. The cycle amplitude is the height of this wave. The amplitude from a trough to a peak is called upcycle amplitude, and the amplitude from a peak to a trough is called downcycle amplitude. The cycle length is the distance between two peaks or the distance between two troughs. We can analyze the highs and lows in the price chart with these elements in mind. For example, in an uptrend, the upcycle amplitude is generally larger than the downcycle amplitude. That's why price progresses to the upside. The net change in each cycle amplitude is positive. Notice also that in this image, cycle lengths are equal, meaning that the horizontal space between peaks or between troughs is the same. In a downtrend, the downcycle amplitude is larger than the upcycle amplitude, creating a negative net change. That's why price progresses to the downside. In this example, the cycle lengths are also equal for simplicity's sake. In terms of cycle amplitude, there are three possible types of price action: neutral, converging, and diverging. These names come from the relationship between highs and lows. In this image, you can see an example of neutral price action, which means a constant cycle amplitude. The highs and lows are parallel. This means that the trend is balanced and therefore sustainable. In this next image, you can see an example of converging price action, meaning that highs and lows are approaching each other by a gradual decrease in cycle amplitude. There is a decrease in volatility, which means that there is a decrease in trend power. In this next image, you can see divergent price action, meaning that highs and lows are getting apart from each other. This means an increase in volatility and the fact that the trend is getting stronger. This is a sign of trend continuation. The same exact logic applies for a downtrend, of course. The other way of looking at cycles is through their length. As a general guideline, a gradual decrease in cycle length is a sign of trend weakness. A decrease in cycle length while cycle amplitude is maintained will naturally produce movements that are not sustainable. Movements that go through a wide price range in a short amount of time are exhaustive, even though they appear to be strong. Since exhaustive movements like that are not sustainable, it leads to the conclusion that a gradual decrease in cycle length is a sign of an imminent reversal. On the other hand, a gradual increase in cycle length while amplitude remains equal is a sign of continuation. That's because there is time for price action to create up and down movements in a sustainable fashion. In terms of cycle analysis, there are two signs to look for when scanning for a power decrease in the trend, which means the possibility of a trend reversal. The first is a gradual decrease in cycle amplitude while cycle length remains constant, and the second is a gradual decrease in cycle length while cycle amplitude remains constant. We are looking at these possibilities in isolation, but they can occur in synchrony, which will lead to different signals. I will leave that for another day since psychoanalysis goes way beyond this brief introduction. Another way of assessing the strength of a trend is to analyze the size of retracements. If the retracement size is decreasing, it means that the dominant market player is becoming more powerful, and therefore, the trend will pick up speed. If the size of retracements increases, it means that the dominant market player is becoming less powerful, and therefore the trend will slow down. In this illustration, you can see how the overall trend seems to slow down as progressively larger retracements appear. A larger retracement means that the subdominant market player has more space to breathe. The opposite scenario can also occur, indicating an increase in the power behind the trend. The classic example of this is when the trend is reacting to a well-established sloping channel, like you can see in this image. In a certain point, the expectation that the market will retrace to the channel boundary is frustrated, which immediately translates into a retracement with smaller size. After that, price breaks to the other boundary of the channel and there is an increase in trend power. Another way of assessing the power behind the trend is to look at the candlestick ranges. The candlestick range is nothing more than the distance between the candle extremes. The average candlestick range can be easily observed through the ATR indicator, which stands for average true range. A decrease in the average true range means that candlesticks are narrowing, which implies that the dominant market player lacks the power to produce powerful wide movements in the trend direction. A decrease in ATR while price advances the trend direction is a sign that the power behind the trend is weakening. In this illustration, you can see that a decrease in ATR while price is advancing to the upside is a sign that the trend is weakening. A decrease in ATR while price is advancing to the downside is also a sign that the trend is weakening. The bullish and bearish signals are the same because the ATR cannot have negative values. Logically, an increase in ATR is a sign that the power behind the trend is increasing. One subtle way of assessing the sustainability of a trend is to analyze something called price persistence, which is the quality of price action. The property that makes price action sustainable is when candlesticks have approximately equal medium ranges. Whenever price decreases or increases candle range too much, price action ceases to be sustainable, or in terms of price persistence, it ceases to be high-quality price action. Candle ranges that are too narrow produce things like inside candles, which are often present at reversals. And candle ranges that are too wide produce things like exhaustion candles, which are also present at reversals. In other words, the continuity of a price movement relies on candlestick ranges not being too narrow nor too wide, relatively speaking. Take a look at this illustration. This is an example of sustainable price action. All candles display roughly the same medium range. This means that a movement like this can continue for a long time because price is balanced. In this next illustration, you can see one of the examples of unsustainable price action because candle ranges begin to narrow as price advances. This is what we talked about previously. In a situation like this, you would see the ATR indicator dropping. The other example of unsustainable price action is when candle ranges begin to widen, as you can see in this other illustration. Price cannot continue creating progressively wider candles like this, so this is an exhaustive movement that eventually leads to a reversal. Either narrowing or widening candle ranges will produce a reversal. The only possible way for price to continue in one direction for a long time is when there are medium ranges. The candle stochastic is simply where the closing price dwells in relationship to the candle range. Generally speaking, if candlesticks are closing on their upper range, it means that there is more bullish pressure than bearish pressure, and if candlesticks are closing more on their lower range, there is more bearish pressure than bullish pressure. In other words, candles closing more on their lower range on a bullish trend is a sign that the trend is weakening. Candles closing more on their upper range on a bearish trend is a sign that the trend is weakening as well. In this illustration, you can see that the candle range remains constant, but the candle stochastic changes over time. In an upward price movement, the decrease in candle stochastic means the selling pressure is beginning to appear. This relates into more prominent upper shadows. In a downward price movement, the increase in candle stochastic means that buying pressure is beginning to appear. This translates into more prominent lower shadows. Notice how this naturally gives rise to the famous hammer and inverted hammer candlestick patterns, which often appear at price reversals. We can also look at what's called the candle body to range ratio, which is simply the ratio between the candle body and the candle range. Let's take a moment to think about what this means. A candlestick with a wide range and a wide body, which naturally produces small shadows, is a sign of certainty for the most part. A candlestick with a small body in relation to its range, which naturally produces large shadows, is a sign of indecision. Buyers and sellers are fighting, but there is no clear bias in the candle body. The natural conclusion here is that a lower body to range ratio means that the price movement is weakening. In this illustration, you can see how the decrease in body to range ratio transitions the price movement from certainty to uncertainty, especially when the candle stochastic remains centered. Notice also how this combination of decrease in candle-to-body ratio and centered candle stochastic naturally gives rise to the spinning top and spinning bottom candlestick patterns, which generally mean indecision. It's always interesting to observe the body-to-range ratio in combination with the candle stochastic, as these two things will provide complementary perspectives on price action. We can observe the power behind a trend by seeing its overall angle. Trends can rise at a steady angle, usually when there is the element of price persistence or sustainable price action that was previously discussed. They can start to accelerate or they can start to decelerate. The trend acceleration means that the trend is getting stronger, but it also means that this acceleration is inevitably leading to an exhaustion due to the unsustainability of price movements with too much volatility in a short period of time. The deceleration angle means that the trend is losing power and a reversal might take place. In this image, we see an example of sustainable price action where the overall trend angle is steady. It doesn't accelerate nor decelerate. In this illustration, we can see the overall trend angle getting less steep, which suggests a deceleration in the trend or a power decrease, which tends to lead to a reversal. In this next image, we see the overall trend angle getting steeper, which suggests an acceleration in the trend or a rise in power. This leads to an unsustainable exhaustive price movement, which itself tends to lead to a reversal. In technical analysis, one major way of establishing the likelihood of a reversal is price proximity to a strong barrier. It's not uncommon to see a major price reversal happening at a strong barrier. The greater the strength of this barrier, which can be assessed in many ways, the greater the possibility that price will reverse at it. The key here, of course, is investigating how strong the barrier really is. You must pay attention to things like how many times this barrier has been tested in the past, the relevance of the barrier origin, and how price reacts to this barrier when it reaches it. These three elements must give you a good idea of whether the price barrier is strong enough. Keep in mind that there are many different types of price barriers. Some of them are obvious, like support and resistance lines, and some of them are not obvious at all, like frequency lines and different types of sloped lines. Price can travel the same distance in different ways. This relates to the depth of trend oscillations. With a high oscillatory component or with a low oscillatory component along the way. When there is a high oscillatory component in a trend, it tends to be more reliable because there is profit taking in the retracements and price has time to breathe, so to speak. When price movements occur too rapidly with a low oscillatory component, there's not much time for profit taking, so the movements tend to be unsustainable. This is a little counterintuitive because powerful price movements in one direction give the impression that the market will continue rising, but these powerful price movements are not sustainable in most cases.